Hey everyone, it's Ghostman. And listen, when it comes to building long-term wealth, choosing the right investments is absolutely critical. But here's the thing, there's no one-size-fits-all approach. Your ideal investment strategy depends on a bunch of factors, like your financial goals, how much risk you're comfortable with, and even what's happening in the market right now. Are you trying to buy a house in a few years, retire early, or maybe just grow your wealth over the long term? These are all questions you need to ask yourself before making any investment decisions. And remember, what works for someone else might not be the right fit for you. That's why I always recommend talking to a financial advisor. They can help you create a personalized plan that takes all of your individual needs and goals into account. And don't worry, you don't need to be a millionaire to work with a financial advisor. There are plenty of affordable options out there, so do your research and find one that fits your budget. All right, let's dive into the world of stocks. When you buy stock in a company, you're essentially buying a tiny piece of that company. And the cool thing is, if that company does well, the value of your stock goes up, and you make money. But of course, there's risk involved. If the company doesn't perform well, the value of your stock could go down. Now, you can buy individual stocks, which means you're picking and choosing specific companies you believe in. Or you can invest in ETFs, which are like baskets of stocks that track a particular index, like the S&P 500. ETFs are a great way to diversify your portfolio without having to research hundreds of individual companies. And then there are dividend stocks. These are stocks that actually pay you a portion of their profits just for holding on to them. It's like getting a little bonus payment for being a shareholder. Pretty sweet, right? Now let's talk about real estate, one of my personal favorite investments. Real estate can be a great way to build wealth because it offers both income and appreciation potential. You've got rental income coming in every month, and ideally, the value of your property is going up over time. There are a few different ways to invest in real estate. You can buy a rental property and become a landlord, which can be a great way to generate passive income. Or you can invest in REITs, which are like ETFs for real estate. REITs allow you to invest in a portfolio of properties without having to deal with the hassle of being a landlord. But remember, real estate is not a get-rich-quick scheme. It takes time, effort, and research to be successful. Make sure you understand the local market, the costs involved, and the responsibilities of being a landlord or REIT investor. Let's move on to bonds. Now, bonds are a little different from stocks and real estate. When you buy a bond, you're essentially lending money to a government or a company. In return, they promise to pay you back the principal amount plus interest over a set period of time. Bonds are generally considered to be less risky than stocks, especially government bonds, which are backed by the full faith and credit of the United States government. Corporate bonds, on the other hand, can be a bit riskier, but they also tend to offer higher interest rates. So should you invest in bonds? Well, it depends. Bonds can be a good addition to a diversified portfolio, especially if you're closer to retirement or if you're looking for a more stable investment. Now let's talk about mutual funds and index funds. These are both types of investment funds that pool money from multiple investors to invest in a diversified portfolio of assets. Mutual funds are typically actively managed, meaning there's a team of professional investors who are constantly buying and selling securities, trying to outperform the market. Index funds, on the other hand, are passively managed, which means they simply track a specific market index, like the S&P 500. So, which one is right for you? Well, index funds tend to have lower fees than actively managed funds, and historically they've actually outperformed most actively managed funds over the long term. But some people prefer the potential for higher returns that actively managed funds offer. All right, let's talk about cryptocurrencies. Cryptocurrencies are digital or virtual currencies that use cryptography for security. They've gained a lot of popularity in recent years, and for good reason. Some cryptocurrencies have seen incredible returns like Bitcoin, which has gone up in value exponentially since it was first created. But here's the thing, cryptocurrencies are also incredibly volatile. Their prices can fluctuate wildly, and there's no guarantee that they'll continue to go up in value. In fact, some cryptocurrencies have lost a significant portion of their value in a very short period of time. So, should you invest in cryptocurrencies? Well, it depends on your risk tolerance. If you're comfortable with the volatility and you understand the risks involved, then investing a small portion of your portfolio in cryptocurrencies could make sense. But if you're risk averse, you might want to steer clear. Now let's talk about commodities. Commodities are raw materials or primary agricultural products that can be bought and sold, like gold, oil, and wheat. Investing in commodities can be a good way to diversify your portfolio because their prices tend to move independently of stocks and bonds. For example, when the stock market is down, the price of gold often goes up. Commodities can also be a good hedge against inflation. When the prices of goods and services are rising, the prices of commodities tend to rise as well. Let's face it, not all investments are created equal. Some are about as exciting as watching paint dry, but they serve a purpose. I'm talking about savings accounts and certificates of deposit, or CDs. Now, these are not going to make you rich quick, but they are incredibly safe and reliable. Savings accounts offer a modest interest rate, and you can access your money at any time. CDs, on the other hand, offer a higher interest rate, but you have to lock your money away for a set period of time, typically ranging from a few months to a few years. While the returns might not be as exciting as, say, investing in Tesla, savings accounts and CDs are great for short-term savings goals, like an emergency fund or a down payment on a house. You know your money is safe and sound, earning a little bit of interest. Now let's dive into the world of peer-to-peer lending, or P2P lending for short. This is a fascinating way to invest that cuts out the traditional financial middleman like banks. With P2P lending, you're essentially lending money directly to borrowers through online platforms. These platforms connect borrowers with investors, and you can choose which loans you want to invest in based on the borrower's creditworthiness and the interest rate offered. P2P lending can be a great way to earn higher returns than you would from traditional savings accounts or CDs. However, it's important to remember that there's always the risk that the borrower could default on their loan. That's why it's crucial to diversify your P2P investments across multiple borrowers to mitigate your risk. All right, for those of you who are feeling adventurous, let's talk about venture capital and startups. This is where the big money is made, but it's also incredibly risky. Venture capital is a form of private equity financing that's provided by investors to startup companies and small businesses that are believed to have long-term growth potential. These startups are often developing cutting-edge technologies or disrupting entire industries. Now, investing in startups is not for the faint of heart. The vast majority of startups fail, but the ones that succeed can generate massive returns for early investors. Think Uber, Airbnb, or Facebook. If you had invested in those companies early on, you'd be sitting on a gold mine right now. Finally, let's explore the world of alternative investments. These are investments that fall outside the traditional asset classes of stocks, bonds, and real estate. One example is investing in collectibles, like art, wine, or vintage cars. These assets can appreciate in value over time, but their value is also subjective and can fluctuate based on market trends and demand. Another alternative investment is hedge funds. Hedge funds are investment funds that use advanced investment strategies and leverage to generate high returns. However, they're also very risky and are typically only available to accredited investors, meaning individuals with a high net worth. So there you have it, a rundown of some of the best investment options for 2024. Remember, the key to successful investing is to diversify your portfolio, understand your risk tolerance, and align your investments with your financial goals. Don't be afraid to do your research, ask questions, and seek professional advice when needed. Investing can seem daunting, but it's an essential part of building long-term wealth and securing your financial future. Thanks for watching, and remember, the best time to start investing was yesterday. The next best time is today.